And the highly anticipated huge day for inflation, the CPI number that was going to solve everything, comes right in their forecast and doesn't move interest rates at all. And there's a reason for that. We talked about it several times before. We are going to have to see consecutive months of inflation pulling back. So coming in right at forecast doesn't change any minds of Fed members. And that's what everyone is really hinging on, because you basically have two things right now driving interest rates. Obviously, you have the conflict. The conflict creates uncertainty. It creates inflation. And the longer it goes on, Fed members believe embedded inflation. On the flip side of that, we have data. So they need to see inflation pulling back consecutive months. And I'm talking probably a quarter or two where they become more dovish. Or we need to see the labor market really start to struggle. Last week, we saw the labor market pulling back a little bit. More importantly, we see wages pulling back a little bit. So things are moving in the right direction on the data side. So right now, without the conflict, I believe we have lower interest rates. But as long as oil's going to sit above $80 a barrel, that's not happening. So you're going to see rates remain elevated. So who am I? My name is Kevin Weidmark, aka the Mortgage Mouth. Each and every day I come to you with what happened in the marketplace, how it affected interest rates, and should we float or lock. And I'm doing this nationwide, offering financial and commercial lending. Been doing it well over 25 years. So if you need anything, you give this guy a call right here. So what do we have for the rest of the week? We really don't have much. We will have initial jobless claims tomorrow. I think that's a bigger read than what a lot of other people will say, but I don't expect any shock waves. So we're now going to have to wait for PCE. We'll be digesting some ISM numbers. We have some auctions. But overall, until we get this conflict pulling back and we get consecutive months of data moving in our direction, rates are going to remain elevated. So should we float or lock? I would be floating. And right now, I think the market is still going to price in a rate hike, but it not necessarily is going to be in September. So I'd be in float mode and hope that we get some resolution to this conflict, or we get rhetoric of a future resolution, because that will allow rates to drop. And quite possibly then I would take an opportunity to lock. And as always, if you need to lock, make sure you're utilizing yield spread premium, full disclosure from your lender, so that you can use that money to pay for those closing costs, create more affordability, save thousands, so you're in a better financial position to refinance when necessary. Need a topic covered? Let me know. Subscriptions. Hit that subscription button. I'll be coming to you tomorrow. Cheers.